To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, so we discussed about what are the various ways or what is the process of valuing a future contract or a forward contract, and we also understood that the difference between pricing these two kinds of contract is very similar. There may be small changes here and there because of transaction costs, taxes, other things. Keeping those things aside, we understood how the pricing is done for futures contracts or forward contracts. We will solve the problems of futures and forward contracts. It's some bit, or let's say some time away from now. Let us not solve all those problems right away, because there are some more important concepts that we need to understand with respect to futures and forwards. Before moving there, first, if you remember, I had mentioned to you that futures contracts exist for stocks. Futures contracts exist for commodities, let's say metal, gold, several other things. Futures contract exists even for currencies. Future contracts also exist for interest rates. Future contracts exist even for bonds. There are even electricity futures. Okay, so you actually have these kind of future contracts which are traded on various exchanges for various kinds of asset classes. I have listed 6 or 7 asset classes, right? So these future contracts, for each one of them, have their own specific characteristics. See, because the way a commodity happens or the way a commodity trades may be very different from the way a interest rate future trades, or the way a currency trades, or the way a stock market trades, or even in stocks. There is one significant, let's say breakup, or let's say there are again two types of stock market related futures. One is individual stock futures, that is for a specific security. We can say I can trade in futures of ICICI Bank, or I can trade in futures of Reliance Industries, TCS, Infosys, Wipro, so on and so forth. Okay, that is one set. You can also trade on futures of indices. If you remember, we discussed this in our one of our previous sessions, where I said that you can actually buy Nifty. You can buy BSE 500, you can buy Bank Nifty, you can buy PSU Nifty, stuff like that. I had given you examples of that also. So futures can be divided into these two: individual stock futures or index futures. Right, now we will delve into these other varieties of futures of currencies, interest rate, commodity, then electricity. It is not there in our syllabus, but I just gave an example. All of this we'll keep aside. For the moment, let us concentrate on this first part, which is basically your stock futures, where individual stock futures or your index futures. But before we get into the depth of what these two are, there is one very important concept that we all need to understand. I had referred to this concept in one of our previous sessions, where I was actually telling you that there is something called as a margin, there is something called as an MTM, the gain made by the buyer is equal to the loss made by the seller, and I had given you broad data. Right. I also told you that we will discuss later in depth. So now we are going to discuss that. We are going to discuss this entire concept of what is this whole thing about margin, why is there something called as a margin, what is this whole thing of MTM, how does this MTM, or how is this MTM computed, what is the relationship between this margin and MTM, and then we will actually try and understand what are the kinds of various futures transactions that can be entered into. After we finish that, we will get into problems. Okay, so 3 steps. First, let us understand MTM and margin. Then we'll understand some kinds of strategies based on futures contracts for, let's say, stocks or indices. Then we will get into problems. Okay, this is the step. And when we get into problems, we'll first solve all the problems of futures, where we said about pricing, where we use this epsilon and all of that. All those problems, as well as these futures contract related problems where you have to maintain margin and all of that. All futures contracts related problems we'll solve together. Fair enough. So this is the way we are going to proceed. So now let us get into the first aspect of this, which is what is this whole concept of margin or MTM, how are they both interrelated? Okay, so now let us assume that you want to enter into a futures contract. Let us take very simple example of Reliance Industries share, and you want to enter into a futures contract for that particular share. Assume that the share price is 1000, and we'll keep all numbers and all dates all very simplistic, so that it is easy to understand. On 1st January of a year, you are planning to enter into a contract. Okay, or you rather enter into a contract. Today the price is 1000 and you want to enter into a contract which is maturing 90 days later, which is on 31st of March, 90 days or 91 days, 31st of March. Okay, On that day, you are entering into a contract to buy the Reliance Industries share, let us say 100 shares at, let us say, 1000 is the current price, you think it will go up to 1100. So, you will say, I will buy it at 1100, you enter into a contract. On the other side, there is a party who also enters into a contract who is willing to, sell to you at 1100 rupees on a future date. Agreed? So far, so good. Very, very simple transaction. Now, based on this, what did we discuss earlier? If you remember, when we discussed about that brinjal example, right? Farmer, you go to the market and buy, and then I said, no, but either party can default, and that is why we have an exchange. In exchange, there is an exchange mechanism where the exchange collects some amount of money from both the parties and all of that. I only gave you a gist of the issue. See, when you enter into a contract with some X or A or whoever it is for this Reliance Industries shares, you are basically trusting that the other party will honor the contract. And the other party is also trusting that you will honor the contract depending on whatever is the price. So, let us say the price goes up, probably you make a gain, price goes down, probably the other party makes a gain, correct? Both of you are trusting that this contract will be executed. So, one of the most important things what we discussed at that point of time was exchange acts as a mechanism, exchange along with the clearing house when they do this whole settlement process. That is, they are the intermediary in between you and this third party. There is a intermediary who actually ensures that the transaction goes through. And how will they ensure that the transaction goes through? They will say, when you are entering, you please put some money out of 1000 rupees, and 1100 rupees is the price, 1000 rupees is today's price. You put 10%, 15%, 20%, some number you put as deposit with the exchange. Same way, the third party is also asked to put some money, 10%, 20%, 30%. We'll come to these percentages, okay? But the core idea is there is somebody in between who is forcing both of you to deposit some money. Why is this exchange asking both of you to deposit some money? Because they have to ensure that the contract is honored on both sides, irrespective of which way the stock goes, whether it goes up or whether it goes down. One of the parties will be at gain, other party will be at loss, and hence they are asking both of you to actually deposit some money. Now friends, if you remember our chapter 2, what we discussed where we talked about risk management, and there was a concept called VAR, V-A-R, value at risk, if you remember. So that concept actually comes into play. See, what is the risk here? What is the risk? That you default or the other party defaults without honoring the contract if one of them is in loss, correct? That is the risk. How do you measure that risk? You measure that risk, or you ask for a deposit that compensates for that risk by using this concept of VAR or VAR. How do you use that concept? You will say, let us say on an average, let us say every day the stock market, or let us say this particular Reliance Industries stock, maximum volatility in its returns or maximum variation in its daily returns, let us say is 2% or 3% or 4%. Okay, on a single day, it can go up or down by 4%. Historically, if you look at, 99.99% cases, remember this concept, what we discussed in chapter 2. So, you take that number, it could be anything, 2, 3, 4, 5, I don't know, I'm just making a guess here. Okay, you can actually get the data when, if you plot all the Reliance Industries stock price, or you can go to the, NSE and search for that particular VAR, and you'll probably get it. Okay, but keep that point aside. Look at the concept, underlying concept. The concept is that volatility of returns is, or basically it identifies by what percentage that the stock price can actually move. Because of that movement, in a single day, the risk that you have to bear or the third party has to bear is usually limited to that, correct? So, there is a risk that the price may go up and down. That price may go up and down is usually in a certain band. The exchange is asking you to deposit a money by doing some computation, and the most important input in that computation is this VAR. So, you deposit this 10%, 20%, whatever number, right? Let us assume 20%. You are asked to deposit 20%. The 20% number is computed largely by using a formula in which the key input is VAR. Understood? Okay, so what does that mean? That means that the maximum variation in returns of that particular stock price you are trying to capture and ask the respective clients, or you or X, you are asking both of them to deposit that money. money which is linked to that money which is computed by using some formula and VAR. Okay, so you compute VAR into some 2, 3, 4, 5, some number. So there is a basis and a logic for how exchanges compute the margin. Okay, and that particular margin is typically, for different stocks it may be different items, or for Nifty contracts it may be different. It depends on the volatility of the underlying asset. Fair enough. So far you understood this concept. Now if you have understood this concept till here, the way exchange will work, or the way exchange does this entire thing, is they will ask both of you to deposit, and I also told you that there is a formula, right, this margin formula. The margin usually consists of two elements. One is, and when you deposit the margin, let's say when you enter into a contract, you initially put up that 20% of the value. So when I say value, of what value? Of the contract value. What is the contract value here? Here you are saying 1000 rupees today's Reliance price, 1100 is price after 1 month. Let us say you are buying 10 shares of Reliance, agreeing to buy 10 shares of Reliance at a future date at 1100 rupees. The contract value is 1100 into 10. 1100 into 10, 20% of that is the margin that they are asking you to deposit. Okay, I am taking 20% as an illustrative case. It is not exactly 20, it depends, it changes based on stock to stock and all of that stuff. Now, that 20% number, what is being asked to deposit, is called as initial margin. This initial margin, okay, this initial margin of 20% has one component inside it which is called maintenance margin. So initially you put 20, okay, when you start the exercise or when you start the contract you put 20, but you have to at minimum maintain 15. So at any point of time on day 0 you put 20, you cannot take out the 20 immediately, or you cannot take out the 5, 20 minus 15, I told you minimum number 15, right? You cannot take out that 5. However, let us say when this 20, the contract value keeps changing, let's say the future price keeps changing, and let's say this margin number comes down to 16, 17, nothing happens, you don't have to do anything. Moment it comes below 15, you have to come and put back the entire value of the margin again up to 20. So that is the difference between 20 and 14 and a half or 15, wherever it ends. So let us say from 16 it fell to 14 suddenly. How did it fall? We will discuss again, but I am just giving you, first understand this concept of initial margin and maintenance margin. So initially you put some money, moment it drops below a certain level, you are again supposed to recoup everything and bring it back to 20. Okay, so these are the two aspects. Now with respect to NSE terminology, or let us say you look at, NSE is the world's largest exchange with respect to the number of contracts that are traded, okay, specifically with respect to derivatives. So if you look at NSE terminology on what is this margin, they have something called as span margin and something called as exposure margin. Initial margin consists of span and exposure. Now this 20% whatever we discussed, it comprises of the span and exposure. If you look at NSE definition of what span is, standardized portfolio analysis of risk. So basically that VAR, whatever I was trying to tell you. So NSE has this terminology of span margin plus exposure margin, and the span margin is basic maintenance margin, which is equivalent to maintenance margin, right? So now let us actually go slightly deeper, look at what NSE says, what they say on the website, and let us look at some examples of how these margin numbers are, so that you actually understand whatever we have discussed so far, right? So let us look at that part. Secondly, one more critical point I want to highlight to you is, with respect to futures, we also discussed that futures contracts are done in lots. When I say lot, that is you have to buy minimum X quantity, whereas forward contracts can be structured depending on whatever size you want, because it is between party to party. Whereas in case of an exchange traded futures, you have to necessarily do in lots of, let's say, 50 contracts, 100 contracts, 1000 contracts, something like that, right? So NSE also prescribes what are the minimum lot sizes, let's say for Nifty, for some Reliance, for Axis Bank, ICICI Bank, TCS, like that. So they specify the lot size also. Now let us go into the NSE website first and understand what this whole margin structure is, and also understand what are these lot sizes. Once we understand that, we will come back and then we will take a comprehensive example which will help you understand this thing in full depth. Okay? So friends, now let's just go to the NSE website and figure out what is this whole story of margins. Once we understand the story of margin, we'll also understand MTM. As I said, we'll do a comprehensive problem, or basically an example which will help us understand the whole story in one single shot. Okay, so let me search for NSE margin requirements. Okay, so I'm going to the first one. So if you look at it here, it says NSE has developed a comprehensive risk containment mechanism, so on and so forth. The actual margining and positioning is done on an intraday basis. NSE clearing uses the SPAN, Standard Portfolio Analysis of Risk System, for purpose of margining, which is a portfolio based system. The initial margin consists of SPAN margin, right, and then additional base capital, extreme loss margin. So basically NSE, when they compute this whole margin number, they also add some buffer. What is a buffer? Buffer means little extra. They ask for extra money. Why? Because suddenly one of the days, index moves by 5% or 6%, the risk that one of the parties does not honor the contract becomes very high. So they add their buffers. So the formula, whatever they use, they have deep working on that formula, but they also add additional buffers. And they have also given what is the notional, what for a futures contract, how is this computed, how is the margin computed, all of that they have given details. Now let me go back and open another link, the second link if I am not wrong. Yes, this is the older website. This has slightly better detail. Okay, so in this they also say they have something called exposure margin. So SPAN is basically your maintenance margin, and there is something called as exposure margin which is in top, and they also have additional margins like assignment margin, premium margin, extreme loss margin, like that. They have varieties of margin, all of them are bundled together, and there is a single number called initial margin. Okay, so far this part is clear. Initial margin, as I said, 20%, out of that maintenance margin, let us say, is 15%. So out of 20, 15 is maintenance margin. So initially you have to put 20% of the contract value, and whenever the margin value comes below 15, you have to recoup or put back money into that so that the number reaches 20 again. Okay, how does this reach? We will discuss. First part, this is what I wanted to show you, that our NSE exactly follows very similar kind of system. Okay, next what I wanted to show you in this was basically the number of lots. So let us search for that. Let us go to Google and search for NSE lot sizes. So here they say, and underlying is Nifty contract, download the lot size file. So I am actually clicking this file. So now let us look at this particular Excel sheet what we have downloaded from NSE website. It gives us details of what are the lot sizes. So it says for Nifty Financial Services, the lot size is 40. For Nifty Bank Index, the lot size is 25. For Nifty 50, the lot size is 75. So what do you mean by lot size here? Let us say Nifty today is trading at, argument's sake, let us say 10,000 or 15,000, some number. Just I'm not trying to tell you the exact number for today. I'm just telling you, let's say Nifty is trading at 15,000. So you have to buy 15,000 into 75. Okay, whatever number that comes to, I think it probably comes to some 112500, something like that. Let us compute that number. 15,000 this into 75. So the contract value, the traded value at minimum is this 11,25,000. Okay, that is a minimum transaction size. And for that the margin is computed as 20% of this or 10%, whatever the margin is. We will go into that particular aspect later. So you have to initially put 20% of this in order to even do a transaction on Nifty. Same way for different stocks, it is different level. So let us look at Reliance, which is our favorite, 250 minimum. Let's say Reliance share price is 1,000 rupees today. So 1,000 rupees into 250, that is 2,50,000 is the minimum contract value. On that, the money that you have to give to your broker who will deposit with the clearing house and all of that, that is 2,50,000 into some 20%, 10%, some number, whatever that margin percentage is. Right. So this gives us an understanding of what is lot size, what is the how margin has to be put. Now let us take a step back and actually try and solve a very simple problem which explains that whole concept of MTM and margin together. So friends, now for our example, again we will take live data. Okay, we will take data from NSE and see how those numbers are flowing. And this time we will take an index so that it is easier to understand. So first let me go to nseindia.com. and type for an index called Nifty. Nifty is basically the 50 stock index which represents broadly the way the market moves, correct? We discussed this earlier. So now Nifty derivatives, if you come down, it is asking us all contracts, option chain, all historical data, glossary, filter by instrument type, expiry date. We will take instrument, we are discussing about futures, so let us now go only to futures. If you look at futures here, right, here it shows for 3 days, futures expiry for 3 days, 25th February, 25th March and 29th April. What are these dates? If you remember in one of the previous sessions, I said that all the futures contracts usually expire on the last Thursday of a month. Okay, so in these, you can go and check the calendar in 2021, these 3 dates are the last Thursdays, unless that Thursday happens to be holiday, in which case it probably will be Wednesday and all of that stuff. Okay, so and in Indian context, index futures and stock futures, primarily futures, again I am referring to futures, primarily trade for 3 periods. One is near month, which is, let's say we are in February, February is near month. Second is mid month, that is March is called mid month, and April is called far month. So let us say you are standing on 1st of January of a year. Okay, the contract for the current month is called near month, the contract for February is called mid month, and the contract for March is called far month. Okay, so always 3 kinds of futures contracts are available, and these expire on that particular day. And as I said, in our case, because Nifty is an index, delivery cannot happen. These are all settled by cash. So either you close out the contract in advance, or on that day you wait for the contract to get closed. Either ways, whatever happens, gain or loss, will happen on that day that particular contract is ended. If you want to again come into the next month contract, there is a process called rollover. That is an independent one. We will discuss that later. But for you to understand, there are these 3 things, these 3 contracts that are available for you to trade. Now, basis on this data, so in this case, let us say we are talking about 25th March 2021, and the Nifty closing price, let us say is, or let us say it is currently, market is currently working, right? So the last price is 15,173. Let us take the same 15,173 or 174, and at this point, what is the current Nifty value? Underlying value is 15,082.60. So today the spot is 15,082.60, and today let's say is 25th of February or 24th of February. This particular last traded price for the February future is 15,102, March future is 15,173, and April future is 15,255. We discussed about something called contango, that is prices are broadly expected to go up because there is an opportunity cost or the cost of carry, right? Very, very clearly visible. Now, let us take the example of this March 2021 settlement future, that is whatever the contract is going to mature on 25th of March. For that, let us draw certain, some amount of information or feed some amount of information and then understand what is this whole margin wala story. Okay, let us understand what is this whole margin story. Okay, fair enough. So we will take current spot as 15,082, or let me round it off, let me make it 15,100 is the current value of the index, and let me make this March 25th future as 15,200. Okay, easiest, 15,100 is spot, next middle month future is 15,200. Okay, so now we will take the data, we will put it in an Excel, and we will assume certain things and then start seeing how things evolve. Okay, fair enough. Chalo, let's start off on that. Nifty, let us assume spot to be how much? I think we said 15,100, right? So 15,100. Then we have Nifty futures. We on that day, we also said we'll round it off and keep it at 15,200. So let us put it at 15,200. Then let us take the contract date. Okay, as I think we can take it as 1st of March. 01 March 20XX. Okay, on this day the spot is 15,100, and on this day the future price for which maturity date? Maturity date, let's say, is 25th March 20XX. Okay, for 25th March expiry, the future price is 15,200, whereas today spot market the price is 15,100. Fair enough. Next, what are the other data points that we have to consider? We also have to consider what is the lot size. The lot size is, I think we saw some 75, let us take it at 50 for easier sake, easy understanding. Okay, and we said initial margin, let us take it at 10%, and maintenance margin, let me put it in short form, maintenance margin is, let us have it at 7.5%. Okay, with this data, let us also assume a movement in prices. Okay, let us not take all 20 days or 30 days. Let us take some 7 or 8 days and see how things evolve. Okay, so first let me put here days. Day, you have day 0 on which you enter the contract. On that day, you have a spot value, you have a future value, future for maturity on 25th of March. Okay, futures price. Okay. On day 0, the spot is 15,100 and future is 15,200, correct? So basically there is a 100 points difference, and let us assume that as we move forward, this 100 points difference is maintained. Why am I saying that? Because futures price is spot plus cost of carry, and for us, in our case, let us assume in a very simplistic manner. I am not trying to complicate it by actually putting the percentage change and all of that. You can do all of that. Very simplistically, in our case, let us assume that cost of carry is 100 rupees. Okay, or that 100, the difference in number. So on day 1, let us say the spot price changes from 15,100 to, let us say we take it at 15,200. So 15,200, then futures price also will increase by 100. Let us make that assumption. I am just assuming cost of carry is 100. Cost of carry is a percentage. I am fully aware of that. For rounding of numbers and make it simpler to understand the concept, let us put it this way. 2, 3, 4, 5, 6. Now in each of the days, let me put a value and let me put the future value as the spot plus 100. I know in reality that will not be the case, but let me add that. Let me take some extreme values, or let's say lot of change. Okay, 14,900, 14,100, suddenly the Nifty collapsed. Okay, just make an assumption, right? Then 15,000, then 15,500 and 14,300. Okay, so as and when the spot falls or spot rises, future also is rising and falling in line with it. Okay, fair enough. This is one part. Now we have to arrive at what is the contract value. So when I told you what is contract value is the lot size into the future price. So let me put this as contract value. This contract value will be this 15,200 into lot 50. Correct? So let me freeze that so that it is easy. Yeah. So this contract value keeps on changing as the days go by. Correct? So if the index goes up, the futures price goes up, the contract value increases. If the index value comes down, contract value decreases. Why is this relevant? Margin is computed on the contract value. Margin is not computed on initial transaction value, initial contract. It is computed, margin keeps changing as the stock price change, or margin keeps changing as the index value changes. So as the contract value changes, your margin also will change. Okay, here one more point what you have to note is the money that we put initially is called initial margin. So what is the initial margin here? Let me say I'll add a thing called margin, and what is the initial value that we put? We said it is 10%. So 76,000 into 10%. Okay, right? So this is the margin that is required to be maintained. Okay, let me copy and paste the same thing. As things go, that is how it will appear. Now, what is maintenance margin? Maintenance margin is again 7.5% of this particular contract value. So let me again freeze that as well. 7.5% into your contract value. Okay, so you have minimum, you have to maintain this much maintenance margin. Fair enough. Now, after this, now let us look at the other data points, which is where things become very interesting. This is when you understand what is this whole MTM concept. Okay, let me also freeze this panes so that we don't have anything to do with the other data, right? Yeah, we are done with the other data. So let me freeze these panes. I will probably, even make this column smaller so that we can see more columns. We call this M margin. So that column is small, and let me freeze this pane. Okay, or I'll freeze this here near the contract value, that is better. Okay, now I have input this data. On day 0, what is my gain or loss? MTM. MTM is basically you are marking your gains or loss to the market. Marking is basically adjusting. In our case, on day 0, we entered in the contract at the last minute. So there is basically no change between what the price at which you entered into the contract and what is the closing value of the particular index in the exchange on that day. So on that day, the loss is 0 or gain is 0. Basically, you enter into contract at 15,100 and 15,200, basically the future value, and the closing value on that day is also 15,200 only. Next day, it has actually increased to 15,300. So your contract value has actually increased from 7,60,000 to 7,65,000. What is your gain? Your gain is 7,65,000 minus 7,60,000. You have made a gain of 5,000. What is the gain in the next day? Is it a gain or loss? So when the market fell, you actually lost 15,000. Okay. Day on day, if you keep computing the difference in contract values, that is your day on day profit or loss. Okay, so now you copy and paste this here. So cumulatively, you've got some gains and losses. Every day there is some gain or loss depending on the way the contract value changes. Okay, so far so good. Now let us come to the next one. When you put this cash, right? Okay, let me add 3 or 4 more columns which will actually help make things much simpler. Opening cash, additional cash, add cash. Then we will have MTM, then closing cash. Okay, have these 4 columns. On day 0, you did not have any cash. You added the whatever is the value of the margin, right? Initial margin 76,000 you added as cash. Okay, so once you did that, and you on that day you did not have any MTM, so you link this to the MTM value. So it is 0. What is your closing cash? Your closing cash is opening plus any cash added plus any gains or losses, same 76,000. Okay. Now copy this part here to the next row. So next day, previous day's closing is opening cash. Same way, this is what it is for all the data points. Add cash. I will come to this point in a minute. Okay. Now let us see MTM. Okay. We have written about MTM. Every day's gain or loss we have computed. So what happens is, if you look at this data, you had initially 76,000 on day 1, opening cash of 76,000, which was your margin, which is what you had put in margin. On that day, index moved up by 100 points and you had 50 contracts. So 100 points into 50 contracts, you get 5,000 profit. What happens to that 5,000 profit is, you entered into the contract with the exchange and on the other side there is another party. Because you made a gain, the other party actually made a loss. Because when you said that you are entering into a contract to buy Nifty futures at 15,200, but now the futures price is already 15,300, you have made that 100 rupees gain on 50 lot size of 50. The other party who has agreed to sell to you at 15,200, correct? Market price is 15,300 and he has agreed to sell to you at 15,200. So that person is actually made a loss of 100. 100 into 50, which is the lot size, he has made a loss of 5,000. So that 5,000 actually is his loss and it is your gain. So what happens in case of futures contract is, this mark to market, that is the gain or loss, is adjusted on a daily basis. So that person actually deposits at 5,000, or the margin that that person maintains out of that 5,000 is taken and it is transferred to you. Okay, so 5,000 whatever is there, that 5,000 actually comes to you. So what happens? Your closing cash increases to 81,000. Initially you had put 76,000. Next day, index moved up by 100 points because lot size is 50, 15 to 100, 5,000, you got the profit. So your cash balance is increased from 76 to 81. Next day what happens? Let us see. Index actually fell. It fell by 300 points. So your futures price also fell by 300. What is your MTM loss? It is 15,000. Now you see one point that you have to note. This MTM loss is always computed from previous day. Why is it computed from previous day? Because when you do MTM, you are adjusting everything till that day. So the original contract is no longer relevant. So you have adjusted everything till yesterday. So now from that closing value, let us start taking and computing profit or loss. So you adjust till a specific date. From that date onwards, you compute the profit or loss again. And that specific date is every day. Every day your profit or loss is calculated, and all subsequent profit or losses are calculated from the immediately previous computation date. Okay. So this MTM is computed from the previous day and current day contract value. So you had 15,000 MTM loss. Now because of it is 15,000 MTM loss, this 15,000 has to go back to the other party from your account. Because we are marking to market every day, right? Every day profits and loss are adjusted. So this 15,000 actually goes away from your account. So 81,000 whatever opening balance you had, 15,000 goes away and your balance is 66,000. Oh my God, balance has fallen to 66,000. What is the maintenance margin required here? Maintenance margin is 56,000. Okay, I am safe. I have to maintain a minimum of 56,250. How is this maintenance margin of 56,250 arrived? You are 7,50,000 into 7.5%. So this 56,250 is your maintenance margin. What is your closing cash balance? Closing cash balance is 66,000. I am safe. Okay, I need not put any extra money. But let us look at next day. Index further fell to 14,100. Collapse. The absolute index collapsed to 800 points, probably 5%. 800 points on 14,000 is 5%. 5% the index collapsed. So what happened? What is your MTM here? MTM is 7,50,000 minus 7,10,000. How did we get 7,10,000 and 7,50,000? 7,10,000 is your 14,200 is the future value into 50 is the lot size. And previous day was 15,000 into 50 lot size. The difference between these two is 40,000 is your loss. This loss, okay, this loss you have to pay to the other party. You have lost money. So it will go away from your account and it will be given to the other party, whoever has entered into a contract. So basically all this mechanism is automatic. It is all done through exchange and your bank and the broker. All of them are linked. So which is why when you open a demat account, you have to link a bank account. When you are opening a trading account, you have to link that to your bank account and you have to put some money as margin. This margin money is blocked. It is held by your broker. Whenever such a loss or gain situation arises, the broker will take away the money. He will not, or he or she will not ask any permission from you. That is the most important feature of futures market, right? Once you put the money in that money is blocked. Whenever there is any money that requires to be paid at the end of the day from your account, they will automatically take it and give it to the other party. Who is the other party? We don't know. We give it to the exchange. See, in an exchange, there are a lot of people who enter into one side of the contract. There are a lot of people who enter into other side of the contract. All the money from these people will come here to their brokers, to the exchange, and these exchange will give it to these brokers will give it to these people. Same way ulta it will happen. So if these guys have lost, their money will come to their brokers, from brokers to the settlement mechanism, to the clearing mechanism, it will come to the exchange, from exchange it will come to your broker, from your broker it will come to your account. That is how this process functions. Now 40,000 is the loss. This 40,000, your opening cash was 66,000 because 15,000 already had gone, and you had a loss of 40,000 MTM. So your closing cash is 26,000. What is the maintenance margin required? Minimum 53,250. You are below maintenance margin. Is this acceptable? No. So the broker, what will happen is the broker will immediately call you. He will say, dear sir, please put the money. Immediately deposit the money. Before end of day, you deposit the money. Typically what happens is, see, I am giving you end of the day scenario. During the day, slowly it is falling, right? When it is falling, moment it reaches 53,250, your broker will not wait. He will immediately sell. He will close the position. What is closing position? That is, he will say, I don't want this contract, I am done with this. Initially you had purchased, now he will sell the contract. Moment it reaches that maintenance margin, if you do not fund the account to improve the maintenance margin back to your initial margin level, the broker will cancel the contract. He will sell off the contract at whatever rate it is, and they will ensure that this number, it cannot come below this 53,250 your margin. Why? Because those are all SEBI and stock exchange guidelines. However, in our example, we are telling you that the money has come down to 26,000. Let's assume that 26,000 it is there. The broker will call and say, sir, it has come down to 26. Yeah, it is below your maintenance level of 53,250, and you have to now bring it back to 71,000. Why 71,000? Maintenance margin is this, but your overall margin should always be 10%. It has to, whenever you recoup it back to the full. What is recoup? Put money back. So whenever you put the money back, you have to bring it back to the original level of 10% of the contract value. That is today's contract value, not original contract value. 10% of contract value. So you will have to add cash of 45,000. Why 45,000? So that your closing cash is 71,000. Why is it has to be 71,000? Because your contract value is 7,10,000 and 10% of that is 71,000. So you put money again into this particular, give it the money to your broker, 45,000, so that your closing cash balance that you maintain with the broker is back to 71,000. Okay, then what happens? Let us see some more interesting stuff. Next day, index again bounces back. One day it is down 5%, next day it is up 5%. So the futures price has gone up to 15,100. Then what is the contract value? 15,100 into 50 units, and 50 the lot size, which basically your 7,55,000 is the contract value. What is the margin you have to maintain? 10% of this, and maintenance margin is 7.5% of this. However, what has happened to your profit? From 7,10,000 you have moved up to 7,55,000. You made a profit of 45,000. What happens to this 45,000? The other party, whoever is the losing party, will deposit to their broker. The broker will give it to the exchange. Exchange will give it to your broker. Your broker will give it to you. Previously, same thing ulta happened. Now when index, when the index value increased, the same, the money is actually coming back. How much has come back? 45,000. So this 45,000, you had opening cash of 71,000 and you have MTM gain of 45,000. So your closing cash balance is 1,16,000. Is there any additional cash you have to deposit? No, you are well above the margin required. This number of 1,16,000 is much higher than your maintenance margin number of 56,000. So you keep that money there. Okay, next day what happens? Again, index further increases. It increases to 15,600. The value of the future March 25th expiry future which you purchased on 1st of March is now 15,600. You purchased it for a price where at 15,200. Now the price is 15,600. So basically 400 rupees you have made gain. That is cumulatively. But are you bothered about that? No, you are bothered only about yesterday's price. Why are you bothered about yesterday's price? Because the entire contract is being marked to market till yesterday. So you are not bothered about 15,200 on day 0. Look here, you are not bothered about this. When you compare this row number, this day number 5, you are comparing only with day number 4. Please remember this. This is very important. So 15,600 into the contract number of lot size of 50, basically 7,80,000. Margin is this much, maintenance margin is this much. And have you made a gain or loss? You have made a gain. Compared to what? Compared to previous day. So 7,80,000 minus 7,55,000, you made 25,000 gain. So your opening cash was 1,16,000, your MTM gain, further gain of 25,000, and your closing cash is 1,41,000. Okay, so you have this 1,41,000. So theoretically, right, this 1,41,000, your margin you have to maintain is how much? 78,000, and minimum maintenance margin is 58,500. So you can actually withdraw some money from this. Brokers allow you to withdraw. Withdraw up to how much? Up to this 78. They allow you to withdraw. However, in our case, we will simply assume that the closing cash balance is maintained there and it is in control of the broker. Okay. Now come to the next day. This day again the market crashed by 5%. My God, what a volatile market. So in this day, crashed by, it moved from 15,600 to 14,400. It is not even 5%, it is some 6%, 7%. So when this happened, what is the contract value? Contract value actually is 14,400 into 50. Of that, margin is 10%, maintenance margin is this much. What is your MTM gain or loss? Your MTM gain or loss is, compared to the previous day, 7,80,000 to 7,20,000. You've lost 60,000 rupees. Your opening cash was 1,41,000 and your loss is 60,000 rupees. You say, I have had enough of this nonsense. Whatever is the gain or loss, let me compute. I am squaring off the contract. What do you mean by squaring off the contract? You give an instruction to your broker that I have a contract which I agreed to buy at 15,200. On what date? Where is that 15,200? On day 0, right? On day 0, I agreed for a contract to buy futures, March 25th expiring futures, 15,200. Today the value is 14,400. Now I will enter into a contract to sell March 25th futures at whatever is the current price of the future. So today I will enter into a contract to sell same March 25th expiry futures at whatever is the current price of those futures at 14,400. So that whatever I agreed to buy, whatever I agreed now I am agreeing to sell, both will cancel each other. So in futures, when you say square off or when you say winding, you are basically saying that you are cancelling the contract. So on this day you say, I am done with this nonsense, whatever is the gain or loss, let me take it. Okay, what is the closing cash here? We said 60,000 is MTM loss, so 1,41,000 was opening cash and MTM is 60,000 loss, closing cash is 81,000. Is this 81,000 higher than minimum maintenance margin and all of that? Yes, it is all higher, but on this day you have nullified the transaction. What do you mean by nullification? Initially you purchase, now you are selling. Even in case of puts and calls, remember the way you square off a contract is, if you have earlier bought a specific contract for a specific maturity date, you will sell same contract for the same maturity date. So the contract gets wound up, okay, or the contract is wound up. Now what is the story here? Now this is 81,000 is closing cash. So do you think we made profit or loss? We made a loss. But no, but cash is higher. No, initially I put 76,000, but the closing value is 81,000. I have made a profit. No, in between you had also added cash of 45,000. What is the total loss or profit on this contract? Let us look at it simply. What is the total? Let me highlight this row and you will understand everything very well. We will actually look at 4 ways in which we can arrive how this particular contract we made gain or loss. MTM is daily adjustment of profits or losses. So if you add up all the MTMs, you will get the cumulative profit or loss. Yes or no? If you add up all the MTMs, you will get cumulative gain or loss on that contract. So let us add all MTMs. 40,000 rupees loss. Is this the only way to compute the gain or loss? No, there are more ways. What is the original cash deployed? Original cash invested is 76,000. Okay. Additional cash, we also added how much? 45,000, correct? Less closing cash, how much is it? 81,000. So net loss stroke gain. So opening I had 76,000 I had put in, I had added 45,000 and then my closing cash is only 81,000. So my loss is 40,000. Okay, this is method 2. Now let us look at method 3. What is method 3? What is the initial value of the at which you enter into contract? Initial, INITIAL, okay, is 15,200. And at what point did you close? Closed or closing is 14,400. So basically value came down by how much? Lot consists of how many units? Lot size is 50. So total loss is 800 into 50, which is 40,000. Is there one more way? Yes, there is a fourth method also. What is the initial contract value? Initial contract value was 7,60,000. What is the closing contract value? 7,20,000. What is the loss? Loss is the difference between these two, 40,000. So in all the cases you see the loss number computation is same. Now in this, have you understood the concept of what is initial margin? That is what is initially put. Maintenance margin, that is how much minimum has to be maintained. If that is breached, you have to again come back to the initial margin level. Not initial margin level in absolute terms, but in percentage terms. We have understood what is MTM. Every day you adjust the profit or losses, and whoever is made the loss will give the money to the broker, broker will give to the exchange, exchange will give to the other broker, broker will give it to the party who's made the profit. Every day this whole sequence of event happens. And you have to deposit cash if the total value of cash with the broker of yours that is lying with the broker goes below your maintenance margin level. You've understood this? This clearly explains the entire process of what is MTM and what is initial margin and maintenance margin. Fair enough. Now let us move into the next aspect of how do you structure transactions with these futures, where you can probably hedge, or you can speculate, or you can when you do a long transaction or when you do a short transaction, how does it work? We'll look into all of that. If you have understood this one thing, right, everything else is very simple.